5 simple tips to help you feel more confident about investing. I know a lot of you are looking to start investing but honestly have no idea where to even begin. And you know what? I get it. The stock market, all these different investments, it can seem super intimidating at first. But the truth is, it doesn't have to be that complicated. With the right approach, literally anyone can start growing their money, and that's what we're diving into today. In this video, I'm breaking down 5 super actionable investment tips, specifically designed for beginners just like you. So, whether you've got $100 or $1,000 to invest, these tips will help guide you on the right path. Before we begin, this video is for educational and informational purposes only, and should not be considered financial advice. Always do your own research before making any financial decisions. Want to start investing but not sure where to begin? You're not alone. The world of investing can seem complicated, but with the right strategies, anyone can grow their wealth over time. In this video, we'll cover 5 smart investment tips for beginners that can help you build a strong financial foundation. Let's get started. The first tip to building a solid investment portfolio is to start with low-risk investments. Now, I know when you're first starting out, you might be tempted to jump into the more volatile stuff, those meme stocks you see blowing up on Wall Street bets. But trust me, as a beginner, you want to prioritize safety and consistency over trying to get rich quick, especially when you're just starting to learn the ropes. So what exactly are low-risk investments? Well, a great place to start is with index funds. Think of index funds like a basket of stocks that track a specific market index, like the S&P 500. When you invest in an S&P 500 index fund, you're essentially buying a tiny piece of the 500 largest companies in the US. This diversification spreads your risk across hundreds of companies instead of just putting all your eggs in one basket. Another great option for beginners is exchange-traded funds, or ETFs. ETFs are similar to index funds in that they offer instant diversification, but they can track different sectors or themes within the market. For example, you can find ETFs that focus on technology, healthcare, renewable energy, you name it. And then there are bonds. Bonds are like IOUs issued by companies or governments. They tend to be less volatile than stocks, making them a good addition for balancing out your portfolio. Now, bonds might not have the same growth potential as stocks in the long run, but they can provide a more stable stream of income, which is especially valuable during market downturns. The key takeaway here is that as a beginner, it's crucial to prioritize investments that can weather market storms and deliver consistent returns over the long haul. Remember, we're playing the long game here, not trying to get lucky with risky bets. Okay, let's talk about diversification. If there's one rule you should absolutely live by in the investing world, it's this: don't put all your eggs in one basket. Seriously, this is non-negotiable. Diversification is the key to minimizing risk and maximizing your chances of long-term success in the market. Think about it like this: if you invest all your money in a single stock, and that stock happens to tank, well, you're out of luck. But if you spread your investments across different asset classes like stocks, bonds, real estate, and even alternative investments like cryptocurrency, you're essentially creating a safety net for your portfolio. Here's the beauty of diversification. When one asset class is down, another might be up. It's all about balancing out the ups and downs of the market. For example, let's say you invested in both tech stocks and real estate. Now imagine the tech industry takes a hit because of a new regulation. Your tech stocks might drop in value, but at the same time, the real estate market might be booming, which would help offset the losses in your tech holdings. Remember, diversification isn't just about what you invest in, but also when you invest. Instead of trying to time the market perfectly, which is nearly impossible, consider using a strategy called dollar-cost averaging. With dollar-cost averaging, you invest a set amount of money at regular intervals, regardless of what the market is doing. This strategy helps you avoid the emotional roller coaster of trying to buy low and sell high. By investing consistently over time, you're essentially averaging out your purchase price and reducing the impact of market volatility on your portfolio. Let's be real for a second. Trying to time the market perfectly is like trying to predict the future. It's practically impossible to do consistently. I mean, sure, you might get lucky once or twice, but trying to buy low and sell high every single time is a recipe for stress and potential losses. Instead of chasing those elusive market peaks and valleys, focus on something much more powerful: consistency. Remember dollar cost averaging, or DCA, that we talked about earlier? This is where it really shines. With DCA, you're essentially taking the guesswork out of investing. You're not trying to time the market. You're simply investing a fixed amount at regular intervals, no matter what the market is doing. Let's say you decide to invest $500 every month into the S&P 500, regardless of whether the market is up, down, or sideways. Some months, your $500 will buy you more shares because the price is lower. Other months, you'll buy fewer shares because the price is higher. Over time, this strategy averages out your purchase price, reducing the impact of market volatility. Think of it like this. You wouldn't wait for the perfect time to buy groceries, right? You buy them consistently, week after week, regardless of whether the price of milk went up or down a few cents. Investing should be no different. The key is to be consistent with your investments, just like you're consistent with your other financial goals. Whether it's $50 a month or $500, find an amount that works for your budget and stick to it. Remember, even small, consistent investments can grow significantly over time, thanks to the power of compound interest. The stock market is a lot like a roller coaster. There are going to be ups and there are going to be downs. If you're in it for the long haul, those short-term fluctuations shouldn't scare you. In fact, they're completely normal. The biggest mistake I see beginners make is letting their emotions dictate their investment decisions. They see the market dip, panic sets in, and they end up selling their investments at a loss, locking in those losses. But here's the thing. Successful investors, they don't panic. They understand that the market moves in cycles. There will be bull markets where prices are going up and bear markets where prices are going down. It's the nature of the beast. Instead of trying to time those cycles perfectly, which is nearly impossible to do consistently, focus on the bigger picture. Ask yourself this: where do I see my investments in 5 years, 10 years, 20 years? The answer to that question should guide your investment strategy, not the daily or even weekly ups and downs of the market. Remember, when you invest in companies or assets you believe in for the long term, those short-term fluctuations become less significant. Let me give you an example. Let's say you invested in Amazon back in the early 2000s. Now, if you had panicked and sold your shares during the dot-com bubble burst, you would have missed out on massive gains. But if you had held on to those shares, even when they lost value in the short term, you would be sitting on some pretty impressive returns right now. The world of investing is constantly evolving. New technologies, new trends, new regulations. It's a lot to keep up with. But here's the thing. The more you know about investing, the better equipped you'll be to make smart decisions with your money. Think of it like this. You wouldn't jump into a car and start driving without first learning the rules of the road, right? Investing is no different. Take the time to educate yourself. Thankfully, we live in an age where information is readily available at our fingertips. There are tons of resources out there, both free and paid, that can help you become a more informed investor. Start by reading books and articles from reputable financial publications. Listen to podcasts hosted by experienced investors. Watch educational videos on YouTube. The key is to be a sponge, constantly absorbing new knowledge and insights. Don't be afraid to ask questions. If you don't understand something, ask. There's no shame in admitting you don't know everything. Remember, investing isn't just about following the latest trends or trying to get rich quick. It's about making informed decisions based on your financial goals, risk tolerance, and understanding of the market. And the more you learn, the better equipped you'll be to navigate the complexities of the financial world. So there you have it, my 5 smart investing tips for beginners. Remember, investing doesn't have to be complicated or intimidating. By following these simple tips, you can start building a solid financial foundation and work towards your long-term financial goals. If you found this video helpful, do me a favor and hit that like button and subscribe to the channel so you don't miss out on any future videos. And hey, if you have any questions or want to share your own investing tips, drop them in the comments below. Until next time, stay informed, invest wisely, and keep crushing it. And there you have it, 5 smart investment tips for beginners. If you found this video helpful, make sure to like, subscribe, and turn on notifications so you never miss an update. Have any investment questions or tips of your own? Drop them in the comments below. I'd love to hear your thoughts. Until next time, invest wisely.